Okay, so now let's get into it because we're going to go ahead and introduce our speakers who are taking us through this conversation today. First, we have Andrew Morse. He is the Senior Vice President at Global Atlantic, a leading annuity and life insurance company. Andrew began his career as an auditor for PricewaterhouseCoopers for 5 years, was controller for the not-for-profit company Bell Excel for 6 years, and most recently has held various roles, all in financial reporting or planning and analysis at Global Atlantic for over 10 years. In his current role, Andrew leads a team of 14 and also collaborates frequently with various functions and customers inside and outside of the company. Great to have you here, Andrew. Wonderful. And next we
Thank you.
have, yes, of course. Next we have Oren Shani. Oren is a credit advisor and certified business coach with AOF. And Oren has over 10 years of experience managing businesses and advising other business owners. He started, managed, and expanded his own business, providing disability accommodations for live events across the country, and he now helps entrepreneurs launch and grow their own businesses. Hey, Oren.
Hello, thanks for having me.
Yes, of course. Okay, so I want to take us through really quickly our agenda. So as we talk about financial fundamentals, we're going to start with understanding the importance of good bookkeeping and good bookkeeping practices. Then we're going to go through some of the fundamental financial documents and calculations that you should know about. And finally, we're going to have that live Q&A. So please continue to engage with us in the chat so we can look at those questions as we wrap up our conversation. So first, Andrew, I'm going to kick it to you to take us through the importance of good bookkeeping practices.
Great. Thank you, Brittany. Hello, everyone. First of all, thanks for inviting me to present today. Spending most of my time in big business, which has an entrepreneurial feel. Very happy to spend this hour supporting the good work that Axion does with all of you small business people and entrepreneurs. And I hope that out of today's presentation that everybody gets something that's useful to you, maybe makes your lives easier, your business is more organized, or otherwise builds out your knowledge base in this important area. When I was controller at Bell Excel, a not-for-profit organization serving elementary school children, as soon as I arrived in that role, we received a $5 million grant from a philanthropist, which was to be paid in 4 equal parts over 4 years. And we made a quick decision that that was revenue in the year that we received the grant, and then we used that grant money for 4 years. The not-for-profit companies have restricted and unrestricted columns in their profit and loss statement. And overall, what this meant was that we had a banner year in the first year where we had $5 million of revenue, and then for the next 4 years, including the first one, we spent $1.25 million of expenses. So it looked like we were losing money for the years 2, 3, and 4. And every time that topic came up over the 4 years, we had to refresh everybody's memory that we had made a decision, that this is what it meant, that the company was in good shape. And everybody got comfortable within a matter of minutes every time that topic came up. In year 3 or so, the auditor questioned whether we had made the right decision there. There was judgment involved. We showed them the same page. We explained our thinking, and they also agreed that that was a reasonable way to do it. And all this is to say that when you're organized around your financial information and you have answers at the ready, whether they're perfect answers or not, everybody gets comfortable, everybody relaxes, and you get to maintain your focus on the business and strategy. All of that is to sort of hit the first bullet point that when you have organized financial records, it frees up time and stress. There are many other good aspects to having organized records. Customers may ask questions, or you may be more on top of the bills, whether they're paying on time or not. Vendors, you never want to fall behind on payments, so you want to be organized around that. But also sometimes vendors overbill you, or there's mistakes in what they're spending you, or you may have questions for them. The more you're on top of that information, the more timely you can send questions out to your vendors. There's a million financial reporting needs in organizations, internal and external. Taxes need to be reported annually. Accountants, the number one purpose of accounting is to provide information to those in leadership who need to make decisions. So the number one use of accounting information is to give people information to make decisions. It may enable you to take an opportunity. It may inform you as to what limits you have in terms of how fast you can grow or can't grow. So you want to have that information ready to go. And again, I'll make this point again. Oftentimes it's important to have the information ready to go, whether it's perfect or not, particularly for decision making. Everybody wants to know pretty quickly what they want to know. And so if you're able to give them information, whoever that stakeholder is, that usually helps move things forward. And finally, in the example of the $5 million grant at the top of this, there are lenders and investors, and usually before they lend or invest, they want to know certain information. Typically, every lender or investor has a different series of questions they ask you. So being agile and being able to answer those questions can be very helpful in terms of attracting a new investor. So there are several types of financial statements. The first type is all internally based. So usually monthly or quarterly reports in terms of how the business is doing. These are prepared usually for management, sometimes goes up to the board of directors. And it's really, these books should be tailored for the purposes of management, right? So you want to get at the information which is important to you, comes out of whatever system you have, and continues to tell the story that's relevant to management. The second group of information, financial statements listed here, are certified public accountant audits and reports. The most typical one that I'm familiar with is an audited statement. That's when annually a certified public accountant, whether it's a small local firm or a big four firm, will come in and they will look at your your statements for either 1 or 2 years, and they will provide an opinion that those statements are reasonably accurate. One point to make there, the statements are actually your responsibility as the business owner. So some people think the auditor comes in and makes the statements. The company actually provides the statements, and then the auditor, their responsibility is to sort of certify for the world that those statements are reasonably accurate. The other types of things here are reviews and compilations. You can hire auditors for both of those other purposes as well. They can come in and play the role of the internal accountant and compile statements for you. They can come in and do a lesser review of an audit, which isn't of statements, which isn't quite an audit, but it's similar. So all three of those things can be prepared by certified public accountants. And lastly, the tax returns. The IRS requires annual returns. Two things I'll say about tax returns. One, you can always extend. So the extension is sort of a run-of-the-mill when it comes to the IRS. That's not necessarily seen as a bad thing. So if you need more time, go through the extension process. Make sure you take the time to get it right. You don't always have to feel like you're under the gun to get these done. And secondly, if you do extend, or even if you don't extend, you do need to pay your taxes quarterly on an estimated basis. So even if you extend, as long as you're paying quarterly, you won't receive any penalties. So those are the points I wanted to make about the types of financial statements. There's basically two different ways two main ways that you can report financial information. One is on a cash basis, and the IRS typically leans towards the cash basis, where they're more interested in whether cash was received or paid. And so the taxable income will sort of drive from when cash was received or paid. Most financial statement readers tend towards the accrual accounting basis, which is generally seen as a more accurate reflection of how a business is doing. The difference between cash and accrual is that you record income when it's earned. So let's say you provide a service for a customer and you bill them $100. You would then record revenue of $100 at that moment when you earned it, even if they take a month or 2 months or 3 months to pay that bill. And similarly, if you incur expenses like monthly, quarterly, annually, you're paying or you're incurring a rent expense, each month you would record the rent expense which you incurred, even if you take 1 month, 2 months, 3 months to pay it. So that usually gives you what we would consider to be the most accurate view of of what the business how the business performed over a period of time, usually a year. And then lastly, in this section, there's a number of different ways you can keep records. There are 4 listed here. The paper ledger, you can keep them however you like, in your own way. I think all of us would pretty quickly go from paper to Excel, where you're basically typing all of your information into a spreadsheet and keeping it that way. The drawbacks of both of paper and Excel is there's no real structure, so you're sort of relying upon yourself to build out any kind of system or process around financial information. So depending on how how much learning you have there, you may be doing things in a standard or non-standard way. The usefulness is that obviously it gets at what you think is most important. So you're keeping records in the way that makes most sense to you, which I think is a very good place to start. So there are drawbacks and advantages to that type of record keeping. Quicken is sort of the lowest level software which you can buy. You can sort of equate this to a checkbook. So basically what you're doing here is you're recording every transaction in and out. The good thing about Quicken is that every type of transaction can be labeled in a category. So let's say you have 4 important revenue categories and 10 important expense categories. You can tag them all, and then you can see all of the activity month over month over month in a very simple report. And then you can drill into every number on that page. So it's a very organized way to keep sort of very simple records. And it works, I think, for some businesses. QuickBooks is now a business software. QuickBooks is made to prepare all of the statements that we're talking about today: balance sheet, profit loss, cash flow. You can do budgeting in QuickBooks. You can break things down by department. So QuickBooks can scale to a pretty large level. When I worked as the controller for that not-for-profit, we used QuickBooks, and it was a $20 million per year company. We did budgeting in QuickBooks. We did budget to actual reporting. We recorded all of our billables, all of our payroll. We used another service for payroll, but all of the financial information was in QuickBooks in a way which was very serviceable for an organization of that size. I think the main point is just choose the software, choose the method which you think makes sense for you, and then commit to it.
Absolutely. Thank you so much, Andrew, for that. And I love that story at the beginning about when you have, your books kept and you have the right financial documents, you're able to answer the questions you need to answer as you move your business forward. So now we're going to get into the actual fundamental financial docs. And Oren, I wanted to see if you could just kick us off with an overview, or what are these key documents that business owners should have in mind?
Yeah, absolutely. Can you hear me all right?
Yes.
Okay, just a quick little tech check. So when we're talking about financial statements, there's really 3 primary types of financial statements that all businesses of all shapes and sizes should be mindful of and should be tracking on a regular basis. That's going to be your profit and loss, your balance sheet, and your cash flow. And I'm going to kind of briefly talk about the differences of each. So everyone should be familiar with the profit and loss. That's kind of the most simple and straightforward financial statement. Essentially, it's just tracking all of the revenue, all of your income coming into the business, and then all of the expenses that sort of chip away at that revenue. And then you kind of, once you factor in all those expenses, whatever is left over, whatever money is left over, is your net profit. That is the wealth that you generated for your business within a particular period of time. That's simply what a profit and loss is doing. It's tracking that revenue, again, your expenses against your revenue, and then whatever's left over is your profit, right? A balance sheet is a little bit different. A balance sheet is really more of a snapshot of the valuation of your company at any given point. So all businesses have value, right? There's a monetary value associated with your business. Your balance sheet is going to reflect what that value and net value is. And I know Andrew will be diving into that a little bit more in detail, just what exactly that means. And then your cash flow essentially tracks the movement of cash in and out of your business over an indicated period of time. I like to think of this as more like the respiratory system of your business, right? Cash comes in, cash goes out. The business owner should really be monitoring that movement on a regular basis to optimize the health of their business, right? So cash flow is really just tracking the cash that comes into your bank accounts, the cash that leaves your bank accounts, and then it also tracks your cash position or the amount of cash you have at any given moment in time. So those are really the three primary or key financial statements that you as a business owner should be looking at on a weekly, maybe even a daily basis. And then we'll dive into each of these, I believe, individually. So let's talk about the profit and loss statement, otherwise known as the income statement. Again, this tracks your revenues, your expenses, and then whatever's left over. And what's nice about the profit and loss statement is there's a visual element to the statement, right? You can always expect the top of the page to be all those revenues, all those incomes, all that, all the money that you're making from selling your products or your services. And as you go down the page, you're starting to chip away at that revenue from all these different types of expenses that we'll get into momentarily. And so you go further down the page, and then at the end, at the very bottom level, your bottom line is your net income, right? You've chipped away all those expenses against your revenue, and then whatever's left over is that profit, that surplus, right? That you, as the business owner, get to have the fun of deciding what you want to do with that. You know, whether you want to recycle it back into the business, if you want to take some payouts from it. That's the name of the game right there. So there's a nice visual structure associated with the profit and loss that I believe makes it very easy to understand. Revenue is always at the top, and you go down the page. You start chipping away at your revenue through all these different types of expenses, and at the very bottom is what's left over. So what are the components of a profit and loss statement? So like I mentioned, is as you can see through this visual, you can kind of see that structure, right? Revenues at the top, sales of your products, sales of your services, and then you start chipping away with all these different types of expenses. So you'll have things like your cost of goods sold, your direct costs, the direct costs that are associated with the revenues that you're making. An example of that would be, if you run a bakery and you sell cupcakes and cakes, your direct costs, your cost of goods sold are going to be the ingredients that you need to make those cupcakes, right? You need to spend some money to create inventory to generate revenue. And that's what we mean by your direct costs. There's a direct association between the ingredients that you need to spend money on in order to generate the sales from selling those cupcakes, right? So that's the first category of costs. And then we start going down the list and we start getting into your operating expenses or your fixed expenses, or otherwise known as overhead. And these are more indirect costs. They're indirectly related to your revenue. So for example, rent. If you own a bakery and you're paying rent, you have to pay that rent regardless of how much revenue you're making. So if you make $0 one month, you still have to pay that rent. So there's an indirect association between that expense and your revenues. So that's what we mean by indirect expenses or overhead. And then what's left over is your net profit. There is an additional expense category here when we talk about your interest, taxes, amortization, depreciation. But I think for the purposes of this, what's really important to understand is the difference between your direct costs, your production costs, and your overhead or your indirect expenses. So let's go through a little example here. Let's talk about Blake's Brake Repair. Blake's Brake Repair, that's a little bit of a tongue twister. So we're looking at Blake's Brake Repair's profit and loss statement. So the first thing we want to look at is the time period, right? So we see two columns here. We see November 30th, 2019, and we see November 30th, 2018. So these are two consecutive years of profit and loss. And you can see kind of what we call the year-over-year sales growth. So in 2018, they generated, as of November 30th, 2018, they generated 95,000 in revenue. And then on the same date in the next consecutive year, they generated 105,000. So there was a year-over-year growth in their revenues, right? So that's essentially what we're looking at here. We're looking at 2 years worth of revenues, expenses, and profits. So let's go down the list, right? We start from the top. This top is always your revenues, always that income that's generated. So we'll just focus on November 30th, 2019 for the purpose of this example. So we see Blake generated 105,000 in revenues. And then we start going down the list. That first expense category is going to be your direct cost of goods sold, production costs, those expenses that are directly related to generating that revenue. So in Blake's case, this is probably going to be parts. He probably purchased $12,000 worth of parts to be able to conduct the repairs to generate that revenue. So his cost of goods sold was $12,000, leading to a gross profit of 93,000, right? 105,000 minus 12,000 is 93,000. Gross profit, what we mean by that is simply just the difference between your direct costs against your revenues, right? So your gross profit is not yet factoring in operating expenses or overhead. We are just looking at the difference between Blake's revenues minus his direct costs, his production costs. Okay, so we look at your gross profit. It's a performance metric, right? It allows you to see how well your business is performing, specifically related to your direct costs and how it's associated with your revenues, right? So that's what we mean by gross profit. So let's keep going down the list. Now let's factor in those operating expenses, that overhead, right? Your rents, your salaries, advertising, insurance, utilities. These are all of those expenses that you need to spend money on to keep the lights on in your business, regardless of your revenues, right? So there's an indirect association with this type of expense compared against your revenues. So again, we're just chipping away at that revenue here. So your total operating expenses, or should I say Blake's total operating expenses in 2019 were 68,000. So we're gonna deduct that from the gross profit of 93,000. So what's left over is about 25,000. Again, we're not factoring in interest, taxes, depreciation, amortization, but bottom line is, literally the bottom line here is you have a net income, or Blake generated a net income or a surplus of $25,000. So that's essentially what we're looking at. Now, this is the Schedule C on your tax return. Now, I would imagine most of our business owners on this call are either sole proprietors or single member LLCs, I would imagine. If that's the case, and you're running a business, you will be submitting a Schedule C as part of your personal taxes, your 1040. Okay, and the Schedule C is essentially a much more complicated way of looking at the profit and loss, as all taxes are seemingly unnecessarily complicated, but that's essentially what we're looking at here is the profit and loss of your business. This is where you report your net incomes to the IRS. As such, a tax liability is created based on those profits. So just to familiarize yourself, now most of you, I'm sure, will have a professional or a CPA fill this out, but it's important for you to be familiar with how those net incomes are being reported to the IRS. And for you sole proprietors and single member LLCs out there, this is the form that's being used to report that.
Wonderful. Oren, we have a really good question in the chat. It's asking, or Diane is asking, is the cost of inventory purchase for resale, for example, clothes, the same as the cost of goods?
I would say so, because again, the way we define a direct cost is anything that the business owner needs to spend money on in order to create inventory that will be sold to generate revenue. So yeah, so I would consider clothes to be the raw materials, which is part of your production cost, part of your cost of revenue. So yes.
Wonderful, thank you.
Okay, and so lastly, and that was a good question. Thank you, Diana. Lastly, just to kind of close out on the P&L, we want to look at three critical profit and loss calculations. These are, again, performance metrics. These allow you as the business owner to see how your revenues and expenses are performing against each other. So the first one that we would look at is sales growth. This is going to be expressed as a percentage. So in the example of Blake's bike repair, we saw those two columns, right? We saw November 30th, 2019. We saw November 30th, 2018, and we can compare those revenues against each other and generate a percentage that indicates the sales growth between those two periods. So that's important to look at because it clearly allows you to see how your revenues are increasing, how your sales are increasing over a period of time, right? It's important to look at that. Then we have your gross profit margin. Again, your gross profit is what's left over after deducting your direct expenses from your revenues. So we express the gross profit margin again as a percentage, and that indicates to you your performance when it specifically related to your direct costs against your revenues. And then your net profit margin is similar to your gross profit margin, but now we're factoring in all that overhead, those rents, those utilities, that insurance costs, which leads to your net profit. And we calculate your net profit margin as a percentage that tells you how well your business is performing from a net profit standpoint. And we'll talk a little bit about how these are calculated. So sales growth calculation, again, this is expressed as a percentage. And there's a formula. So again, we're taking two periods, right? Two reporting periods. In Blake's case, it was 2019 and 2018, right? So we can determine a sales growth calculation based on those two time periods. And essentially what we do is we take the more recent period, November 30th, 2019, minus the previous period, November 30th, 2018, and divide that by the previous period sales. Okay, you multiply that by 100 to get a percentage, and then that becomes your sales growth percentage. So with the example here, we have Blake generated 105,000 in 2019 minus the 95,000 in revenue that he generated in 2018, divided by 95,000, multiply that by 100, and you get a sales growth calculation of 10.5%. So basically, Blake achieved 10.5% sales growth, or in this case, year over year, between 2018 to 2019. So that's what we mean by sales growth calculation. Gross profit margin, it's a little bit more simpler of a formula. You basically just take that gross profit number, divide that by the revenue in the same time period, and then you multiply that by 100 and you get your margin percentage. So in Blake's brake repair example, the gross profit was 93,000 divided by the total revenue of 105,000. So he achieved 89% gross profit for 2019. I think that might have said net profit in the last slide, but that should say gross profit. Now, next slide is net profit. So net profit, same calculation, but now you're taking your net profit number, not your gross profit number. So in Blake's brake repair, that was $25,000 in net profit divided by 105,000 in revenue. So he achieved 23.8% net profit margin in 2019. Cool. So I think Andrew, I'm going to pass it over to you to talk a little bit about the balance sheet.
Okay. Thanks, Oren. Hi again, everyone. Balance sheet is compared to a photograph, a picture. It's really a point in time, right? So what we're trying to get, as Oren mentioned a few minutes ago, is the value of your business at a point in time. People also describe it as what you own and what you owe. So if we can flip to the next slide, there's basically three components of a balance sheet which are important. Assets are what you own at any point in time. And again, you could choose a date. Usually December 31st, 2023 would be like a typical date that you have a balance sheet. End of a year, end of a month, end of a quarter. Assets are what you own. Liabilities are what you owe, either bills for services, long-term debt, and equity is the value that you've created over time. Before we go to the next slides, I think I'll just sort of talk through the subcomponents here, and then the next 3 slides kind of repeat this in greater detail. There's basically a couple subcomponents of each of these. You have current and long-term assets. So current assets are things which will convert to cash generally within a year. So that would include cash. That might include a receivable from a customer. It could include inventory if you're an inventory holding business. I did see in the chat there's a lot of service companies and a lot of companies that have inventory. I think we have both represented very well on this call. Everybody's going to have a different looking balance sheet, right? The types of assets that you have are going to be very different based upon your business. Long-term assets are things that are not going to convert into cash within a year. So that could be an IT system that you pay for, right? And maybe it's helping you for 10 years. It could be a building, it could be furniture, things which will last for more than a year are considered to be long-term assets. Liability is very similar. Anything which you need to pay within a year, typically considered a current liability, and then things which are a year or farther out are long-term liabilities. That could be maybe long-term debt. So again, like rent payments would be current liabilities. Long-term debt, if you borrowed money for 5 years, that would be long-term liability. And then equity is the difference between assets minus liabilities. So if you take all of your assets, you subtract all of your liabilities, you have your leftover value, your equity. That's also parsed into 2 points. Paid-in capital is the amount that you started with, you invested into the business, right? So you start with an amount, and on day one, that's what the business is worth. And then over time, you generate earnings or you generate losses. It can go both ways in any phase of the business. All of that is normal. But over the course of time, you would expect to generate earnings. And the other component of equity is the retained earnings, which represents all of the wealth which you've generated, the surplus you've generated over the history of the business. Assets equals liabilities plus equity, which is another way of saying assets minus liabilities equals equity. The next 3 slides say very much the same as what I went through in the top slide. Current assets, again, convert into cash within 1 year. Inventory, accounts receivables, security deposits, cash. Long-term assets, not easily converted to cash, but instead they are used to produce sales. So I think the part I didn't mention in the top is that those assets do have value, but their value is a little bit more abstract, right? So you have an asset which is going to help you do business for a number of years, and so that gets assigned a value, and that could include things like equipment, furniture and fixtures, leasehold improvements, real estate, land, and intangibles. I don't know if anybody here has intangibles, but intangibles might be something like intellectual property. Like if you have something which is of value to your business, which you've assigned a value to, but it's not something you can touch, that's called an intangible asset. Liabilities. Again, current liabilities expected to be paid within a year. Accounts payable, credit cards, lines of credit, income taxes payable, all of your current bills. Long-term liabilities have a repayment period of more than 1 year. Mortgages, equipment loans, long-term debt. And then the book value of the company. It is what you as an entrepreneur have added as value. So really you have the stock, which is the value to your ownership, the initial investment. And then you have, stock and paid-in capital. So stock and paid-in capital can both be considered investments that somebody made into the business. And then retained earnings is the value that the business builds up over time. And there's an important note to that for entrepreneurs and business owners too, right? That amount builds up over time, but then you can also take it down by distributing money to investors, right? So it does accumulate, but then as you distribute dividends, then the retained earnings comes down. you can consider that to be like a bank, right? So you might build up $100 of retained earnings, then you pay out $20 in dividends. The $20 in cash goes out of your bank account, and then your retained earnings amount goes down by $20 as well. Then I think the next page goes into the example, Paul's guitar shop. So again, this is repeating the same concepts in a visual format. Here you've got your current assets, which for Paul include cash, accounts receivables, prepaid rent, and inventory. Paul presumably has a lot of guitars and strings and other things in his inventory, which is worth $39,000. All of that equals his total assets of total current assets of $73,000. The long-term assets include the $100,000 which Paul spent to build out his shop. He spent $100,000 fitting the shop, which are called leasehold improvements, and that has value for him to sell guitars for the next 10 years, maybe longer. And so there's a value to that, which is assigned as $98,000 in his financial statement. So his total assets are $171,000, comprised of the current plus the long-term assets. And liabilities, very similar. He has bills that he has to pay of $49,000, accounts payable. He has accrued expenses, $450,000. Again, there might be something which has been accrued through the end of this month, but it hasn't been billed yet. But he's captured that as being an expense that he incurred. And then unearned revenue is it's sort of a complex topic, but that's another accrual topic where he may have received money, but he hasn't earned it yet, so he sets up a liability for that. But really, accounts payable is the driver of the current liabilities, 49 out of 50,000. And then he has long-term liabilities, which I'm going to infer is maybe like a long-term debt that he borrowed money from a bank or a mortgage, maybe to make those $100,000 of leasehold improvements. And so he owes that over the long term. So his total liabilities are $149,000. Total assets of $171 minus total liabilities of $149 equals total owner's equity of $21,950. That's how much the business is worth as a book value. And that is made up of $10,000, which was put in as common stock as an investment, and then $11,950, which represents his retained earnings, the accumulated earnings less anything that he's distributed to investors over the life of the business. So there are ratios. When Oren was going through the ratios, I wondered whether out of the 120 people who are on here, some people probably love to go through the math on these ratios, and other people might be, it might be harder to follow, sort of like every single ratio. We're going to go through a couple here. I would say not every single ratio is equally important to every business, right? So the concept of ratios is very important. And I would say that every single business person has a ratio or two or three, which is probably super important to you. So I think the key is like figure out what it is that is important for you in the business to tell you whether you're healthy or not, you're growing or not, and then focus in on that. I do find that reporting ratios month over month, quarter over quarter tends to align people around action, right? If you measure the thing which is important to you, you tend to get better at it, improve it, and sort of focus towards that thing. So I'd say ratios are very important, but it's really tailored to the business. So I'll also, similar to Oren, explain a couple representative ones to you on the balance sheet. The first one is the cash ratio. I think it's listed on the next page. The cash ratio is total cash divided by total current liabilities. So that basically, in this example, you have $32,000 of cash, but you have $50,000 of payables. So you have a 65% or a 0.65 cash ratio. That means to me that this is a lean business. Paul's making money just in time to pay his bills, right? Some people might have a cash ratio of more than one. If you have $60,000 in cash for $50,000 of payables, that means you have enough cash to pay your bills and have a little bit of extra. Both any cash ratio can be fine for that company, right? Somebody might think 0.65 is the best way to manage the business. Other people might want more cash, but if that's an important ratio to you, like that would be one that you could you could report on. It does give you a sense for whether you are cash constrained or not. So this is one that could be helpful if you have concerns about having enough cash. Like this is a good ratio to have. And then the net worth, right? So this is where we talked about already the sort of value of the business, total assets minus total liabilities equals the net worth. We've covered that concept in a couple places already. I would just say, as you apply this to your businesses, I think that the net worth of a balance sheet heavy business, which has inventory and that type of thing, might be a little different than a services business. The services business is going to be not very heavy on the balance sheet. You're basically just going to generate earnings based upon your people and your services every quarter. A balance sheet heavy business where you have inventory or you have product, you're going to have a lot more sort of baked into your assets and liabilities going into this. But regardless, every one of us as business people has a bottom line net worth, which is important.
Awesome. Thank you so much, Andrew. That was really helpful. I think especially when you said different ratios are important for different businesses. So find what you want to pay attention to. And then Oren, can you take us through a little bit about cash flow?
Yeah, absolutely. So cash flow is important. Probably, I would say this is probably the most important out of the three, just in my personal opinion, because with a profit and loss, for instance, you can still run a business with a net loss, but you on a cash flow, you can't run a business without cash, right? You need cash to run a business. Cash is the fuel to this beautiful Shelby Mustang that you built, right? So the cash flow statement is important. What is it? Essentially, like I mentioned before, it monitors the movement of cash in and out of your business. The most simplest way to think about a cash flow statement is your banking statement, right? You go into your bank account, you look at that online activity, you see cash coming in through sales, you see cash leaving through paying bills, and then at the end of that statement, you see kind of that net amount of cash left over. That's essentially a very simplified version of a cash flow statement. Now, there's a more formalized structure to it, which we'll talk about a little bit, but essentially, just conceptually speaking, that's what we're talking about here. We're talking about cash coming in, cash going out, and seeing how much cash you have or your cash position at any particular point in time. Next slide. So cash flow components. Again, we're talking about really two things here. We're talking about all the cash coming in, and we're talking about the cash leaving, and then what's left over is your net cash flow or your cash position. Now, cash inflows. There's three primary sources for a cash inflow. One's going to be through operating activities. So when you sell products or you sell services, your customer pays you in cash, that cash goes into your bank account. That is cash inflow from operating activities through running the operation of the business. Secondly is cash from potential investing activities. So you may have maybe you purchased some equipment, maybe some long-term assets, some property, some machinery. Cash left the accounts to purchase that, and that cash movement falls under the category of investing activities because you made an investment for your business to purchase some equipment or some machinery that you might be using to generate product in a more efficient way, right? And then lastly, we have cash movements from financing activities. So this relates to the use of capital. So let's say that you took out a loan, or let's say that you brought an investor in who gave you a cash infusion into the business. That cash coming in, whether it's from a lender or from an investor, is going to show up as a cash inflow from financing activities. So cash comes in and cash goes out. There's three primary categories in which there's this cash movement through operating activities, investing activities, and financing activities. For the purposes of this presentation, we'll kind of focus on just looking at two categories, which is that just a general inflow of cash, whether that's through operating, financing, or investing, and then cash going out of the accounts. That's kind of how we'll look at this. But again, kind of going back to the very basic concept of a cash flow, we're looking at a cash inflow from various sources and your cash outflow from various sources. And what does that mean for your cash bottom line? What that means for what's the amount of money that's in your bank account, essentially. So next slide. So what can a cash flow statement do for our business? It helps to identify working capital needs. A good example of this is, let's say that you just started your business, right? You're in the post-startup phase. You started generating some revenue, but you just started your business. So you're not operating at full capacity, meaning your revenues are lower and you probably still have a lot of startup expenses. So your expenses are higher. So very normal for post-startup businesses to be operating at a net loss. So instead of generating profit, their expenses are higher than their revenues. So they're operating in a net loss. And that might be okay. And that's pretty normal for new businesses. What your cash flow statement is going to do for you, it's going to help you identify how much cash you're going to need to carry you through this net loss period, so that with the intention that eventually you're going to break even and you're going to start generating a profit. But your cash flow statement is going to allow you to budget for how much cash you're going to need in the meantime until you get to that break-even point. And that's a pretty standard trajectory for most new businesses. Is you're going to start your business, you're going to operate at a net loss for a while. And if you don't, if you start generating profit from day one, that's great. Congratulations, that's awesome. But if not, then your cash flow is going to allow you to budget for how much cash you're going to need to carry you through that net loss period. It helps you predict hard lean times for the business. It helps you diagnose the current state of your business, and it essentially increases profitability by allowing you to understand what your cash needs are. It allows you to create a projection for what your cash needs might be, and allows you to build a budget so that you can operate your business in the most efficient way possible. Next slide. So just looking at a simple example here, again, very straightforward structure here. You have your cash receipts, all that cash coming in from sales. You have your cash paid out, all those bills that you have to pay, and then whatever is left over is the resulting cash position, what you have left over in the bank account after all of this cash movement. Again, cash coming in and going out can be qualified by either operating activities, investing activities, or financing activities. Which, if anyone has any questions about that or additional examples of that, I'm happy to provide that. But essentially, that's what we're looking at here. I mentioned that your cash flow is sort of kind of like the respiratory system of your business. And I really mean that. I mean, you should be monitoring your cash movements on a regular basis, because number one, you need to make sure that you have enough cash. And if you're finding certain trends or patterns in your monthly cash flows, if you see that your cash position is decreasing over time, even though you're generating revenue, but if your bottom line cash position, if your cash reserves are decreasing over time, you're noticing certain patterns, you're noticing certain trends, and you can get in front of the problem by putting certain projections together to better understand what you need to change about your business while you still have cash in the bank, to prevent yourself from getting into a position where you're going to run out of cash. The more you can prepare yourself, the more time in advance that you can see that there is a potential problem, or there's a potential unsustainable decrease in cash flow, the more you get in front of the problem and plan accordingly, and make the strategic decisions that you need to make as a business owner to prevent your business from running out of cash.
Oh my gosh, that was so jam-packed, so full of so much good information. And throughout the conversation, we got a lot of good questions. So we're going to jump right into the Q&A. And this first question is for, I'm going to kick it to Oren. And this is because, as Andrew mentioned earlier, we have some service-based businesses in the crowd. So this attendee is wondering, she operates a salon. Would her cost of goods be equal to hair supplies needed to perform the services?
Yeah, that's a good question. I like the concept of supplies because you can this could be qualified under direct costs, and it could also be qualified under indirect costs depending on the situation. In this example, if you need hair supplies to provide your hair salon services, then that is a direct cost. If there's a direct association between the products that you're using to render the services that you're getting paid for. An example of supplies that may not necessarily be directly associated with your revenues are things like stationery, pens, papers, pads. I mean, those are not types of supplies that have a direct association with the revenues you're making, but those are just some general administrative supplies that you need to run your business, just like you need to pay rent to run your to run your business and keep the lights on. So it depends. Supplies are interesting because there's certain types of supplies that are direct costs, and there's certain types of supplies that are more indirect. But I think in this particular example, I would qualify the hair supplies as direct costs because those are what is needed to generate revenue dollars specifically.
Got it. That makes total sense. Okay, we have another question here. And this one I'm going to kick to Andrew. How can you use these financial documents to make business decisions?
Yeah, it's a good question. So I think let's say you want to make an investment in let's say you want to make an investment in a machine which which improves your product, right? And that machine is worth $20,000, right? You first of all, you start with the balance sheet to see what you have, right? You see whether you have cash, whether you have enough capital to kind of make an investment. Another thing that these can tell you when you look at a profit and loss statement or a cash flow statement, what can you expect after you make that investment? Like, are you immediately going to be in trouble because you're losing money on an annual basis, or your cash ratio is low? So I mean, I think that's one example of whether you make an investment or not. Another example of making financial decisions is just look at your cash flow and your profit loss, both of your activity statements. See if you're growing at the rate you want to grow. See if you're growing your bottom line at the rate that you expected. And if that's not happening as you expected, then you have to look at whether you need to make decisions to grow your top line, maybe through advertising, or support your bottom line by cutting costs, right? So I think that those are the types of general ideas that come out of analyzing your financial information.
Yes, love that about, figuring out if you need, as you get investments, if you're going to make an investment in your business, if you need to cut those bottom lines. We have another question here. I'm going to kick it to Oren. What's a common mistake you see small business owners make when they first start creating their financial documents?
When you first start creating your financial documents, what does that mean? Like if you're just starting to get organized, you're putting together an accounting system, and you're just starting to track your financials. I mean, is that what we mean?
Yeah, I think that's pretty accurate. Like, yes.
I think the biggest mistake is that people focus on their profit and loss too much. I see a lot of my clients, when I ask them about their financials, all they talk about is their revenues and expenses. They're not talking about their balance sheet, and they're not talking about their cash. And what people need to understand is that all of these financial statements, they're networked with one another. There's a connection between all these. They're not siloed from one another. They connect to one another in many different ways. So you have to look at all your financial statements to get a really solid view of the health and performance and opportunities of your business. You can't just look at the profit and loss, because that's not going to give you all the information you need to determine the mechanics of your business, essentially.
Yeah, that's a great point. Andrew, anything to add?
I like the point Oren just made. So I think I started the thing by saying profit loss is like the most accurate measure of a business, right? But when you think about a small business, right, cash is king is a statement you've probably all heard, right? I think if you look at cash flow from operations year over year over year, that tells you whether your company is generating cash, right? If a company is generating cash, then you can make decisions about what to do with that cash. If you're not generating cash, then you're sort of in trouble, right? So I think focusing on the cash flow statement, seeing what that tells you, and then making decisions, consulting with people to make decisions, to make sure you're on the right path and that you're going in the direction you want to go in is a good point.
Thank you so much. And thank you for everyone who attended today and took some time out of your busy workday. I know running a business, you wear so many hats, so we know and appreciate you joining us. Thank you to Oren and to Andrew for taking us through this conversation today and answering all those wonderful questions. And I just want everyone to know, if you asked a question, we just ran out of time, but the support doesn't stop here. There is a free coaching link. You can get a consultation from a coach about your business when it comes to finances or marketing or anything. So we've dropped that there. Thank you all so much for joining, and we will see you in the next one. Bye.